Volkswagen CEO just put a number on the damage, about 2.1 billion euros in tariff costs in the first 9 months of 2025 by his account. Then he said the quiet part out loud. If that tariff burden stays unchanged, large additional investment can't be funded. That's not the language of a press release. That's the language of a hurdle rate failing on a spreadsheet. And it's why the idea of an Audi factory expansion in the US is effectively on ice. Not under review, not maybe later, frozen, unless the economics change. Now here's the twist. Tariffs are often sold as a way to pull factories into America. In some cases, they can do the opposite. They create something more toxic than high costs, a policy risk premium. That's the extra return investors demand when the rules stop being modelable. I work in finance. I don't take my cues from slogans. I take them from phrases like, cannot be funded. Because that's the moment capital allocation behavior flips. Let's start with the obvious incentive. If you're Volkswagen, building more in the United States can reduce exposure to import duties. It's not ideological. It's operational. It's margin protection. The policy backdrop in reporting is usually described like this. There's a 25% tariff on imported cars. It's layered on top of existing duties, like the 2.5% baseline often cited for passenger vehicles. That's how you get the commonly discussed stacked figure around 27.5% in many imported cases. Quick qualifier, because this matters. I'm not saying every vehicle, every pathway, every model faces the exact same stack in the exact same way. The point is the scale. The point is that the import option gets dramatically more expensive under the commonly discussed structure. And in autos, dramatically more expensive doesn't mean a little less profit. It can mean the entire pricing strategy breaks. So the intuitive story goes, raise tariffs and foreign automakers will be forced to build in America. But that story assumes something companies need for 20 to 30-year investments, stable rules. And that assumption is exactly where the model starts to crack. There's also this other layer. There's been a US-EU framework discussed in reporting that would bring tariffs closer to a 15% baseline compared to the higher stacked environment that existed before. That sounds like relief. But factories aren't built on sounds like. Factories are built on whether the rulebook stays put long enough to forecast returns without treating policy like a coin flip. This is where the model breaks. A factory isn't a marketing campaign. It's not a one-year bet. It's a multi-decade commitment. Capital sunk into a place, a labor market, and a supply chain. When a company approves a multi-billion-dollar plant, it's implicitly making 3 bets. Cash flow will be predictable enough to justify tying up capital. The policy environment won't whipsaw in ways that break the economics. The risk can be priced, meaning you can run scenarios that aren't fiction. Tariffs hit all 3, and volatility makes it worse. Let's slow it down. Step 1. Tariffs can create a real cash drain right now. If you're taking tariff hits on imported vehicles, you either pass cost to consumers, absorb it in margins, or do some mix. None of those are painless. Step 2. Volatility pushes up the discount rate. That's what boards and investors require to greenlight a long project. Not because they're panicking, because uncertainty changes the distribution of outcomes. And once you start modeling policy tail risk, low probability, high impact swings, your expected return isn't an anchor anymore. It's a guess. That's what a policy risk premium is. Trust getting priced out. Now add one constraint. A company may need U.S. production to reduce tariff exposure, but the tariff exposure can reduce the cash flows you'd use to fund that production. That's the paradox. Tariffs can simultaneously create the motivation to localize and the financial pressure that makes localization harder to justify. And we've seen operational behavior consistent with that stress. Reporting noted that Audi at one point held vehicles at U.S. ports after the 25% tariff announcement. They were waiting for clarity on how policy would translate into pricing and logistics. That isn't theoretical. That's the real economy reacting in real time. I've watched deals die this way, not because executives suddenly hate a market. Deals die because nobody can stand in front of a board and answer one basic question. What happens to the model if the rules change halfway through the payback period? If the honest answer is, we don't know, the project can die even when demand is still there. Companies don't need certainty. They need rules they can model. If this were only Volkswagen, you could shrug and say, company-specific issue. But capital doesn't move that way. Reporting has pointed to a sharp drop in German investment into the United States during 2025, around a 45% decline over a February to November window, with figures cited around €10, 2 billion versus 19 billion euros the year prior. That's not sentiment, that's allocation. There's also reporting on research showing German exports to the US declined in 2025. Autos were among the categories taking visible damage across the first 3 quarters. Trade and investment aren't the same pipe, but they often reflect the same underlying condition: confidence in the relationship and the stability of the terms. This is why I keep coming back to that wording. Cannot be funded isn't a rhetorical flourish. It's a capital budgeting statement. And when you see that at the same time broader cross-border flows are weakening, you don't treat it as isolated drama. You treat it as a signal that the risk bar has moved. Bring it down from macro to the ground. When a major plant gets frozen, headlines focus on direct jobs. That's visible. It's easy to picture. The bigger effect is what never forms. A large plant tends to pull in suppliers building nearby. It pulls in logistics hubs scaling up. It pulls in workforce training programs expanding around stable demand. It pulls in local tax bases compounding over time. And when the anchor project doesn't happen, that cluster doesn't compound. Here's a concrete way to imagine it. No numbers, just reality. If a major automaker commits to a plant, a stamping supplier might scout land. A battery or components firm might start hiring a local ops team. A community college might build a pipeline for technicians. Local contractors gear up. Small businesses reposition around a predictable base of customers. When the anchor goes on ice, none of that becomes layoffs. It becomes silence. It becomes plans that never turn into payroll. Those are the jobs that never show up in unemployment stats because they were never created in the first place. That's why policy volatility can be more damaging than high costs. High costs hurt. Volatility changes behavior. It turns let's build into let's wait. And waiting is a decision. So what about the obvious counterpoint? If tariffs move down under a framework, say closer to a 15% baseline, doesn't that fix the economics? It can help in the narrow sense. Lower is better than higher. That part is straightforward. But here's the part that matters for long horizon capex. Capital prices credibility, not just the level. If executives learn that trade policy can swing sharply, up, down, threatened, renegotiated, then the premium doesn't vanish the moment the number improves. It decays slowly. It needs a track record. Factories aren't built on maybe it stays. They're built on we can model this for decades. That's why the phrase cannot be funded is so revealing. It's not saying the US market is too small. It's saying the risk-adjusted return doesn't clear the bar under current conditions. One short note on the market mood, and I'll keep this tight. Gold has been printing record levels in recent reporting, including above $5,200 per ounce. Gold moves for a lot of reasons: rates expectations, currency dynamics, global risk appetite. So don't reduce it to one headline. But as a general barometer, it's consistent with a world where uncertainty is being priced higher. And when uncertainty is priced higher, the cost of capital effectively rises, and long projects face harder scrutiny. This is general analysis for information, not financial advice. If you want to know whether Volkswagen is a one-off or an early data point, here's the dashboard I'd watch. 1. On ICE language in earnings calls, not dramatic press releases. Quiet phrasing, pause, delay, reconsider, not feasible under current conditions. That's where the signal shows up first. 2. German FDI into the U.S., especially in manufacturing. The 2025 snapshot matters. What matters more is what happens next. Stabilization, rebound, or continued decline. 3. German export performance to the U.S. in the sectors that carry the relationship. Autos, machinery, chemicals. If those stay weak, it reinforces the story from another angle. 4. Policy headline volatility. Not whether tariffs are high or low on a given day. The frequency of swings is the proxy. Volatility is what raises the risk bar. 5. Operational behavior that shows up before CapEx moves. Holding inventory at ports, rerouting supply chains, adjusting production cadence. Those are early warnings, often months before investment decisions become public. If I had to reduce it to one line, the headline isn't the story, the capital response is. And if I had to reduce it further, I'm not watching rhetoric, I'm watching the hurdle rate. The U.S. is still an enormous market. Market size matters, but market size isn't the whole leverage. Long horizon capital goes where the rules are modelable, where you can forecast returns without treating policy as a random variable that jumps with political winds. When that predictability weakens, the policy risk premium shows up. And once it shows up, it doesn't unwind overnight. Volkswagen's CEO saying cannot be funded makes the mechanism visible. Not because it guarantees a wider trend, because it shows how decisions actually get made. Not with emotion, but with a spreadsheet that stops clearing the bar. Here's the line to remember. A country doesn't lose investment when it gets expensive. It loses investment when it becomes unmodelable.